It's certainly a factor, and I think people are putting too much weight into this factor. When you think about a really good commercial bank, it's got a lot of core deposits, and those core deposits cost the bank very little in the way of rates. And a good commercial bank is also going to lend on a variable rate basis, so they're still making a very nice spread there. If you think about fixed rate lenders, they tend to be more long-term type lenders like insurance companies. Life insurance tends to have long liabilities, they lend long. Most banks don't take a lot of long lending risk, so the short-term impact is minimal. The question is, does the yield curve stay this way, and is it actually forecasting something, or is it that we have something new, like negative rates around the world, which number in the trillions of dollars, which is causing people to look at the U.S. and say it's very attractive, and this yield curve is not telling us anything about a recession.
All right, so let's put it another way. Is there a scenario in the future where the banks still could be a good and even outperforming investment class if this current interest rate environment stays the way it is?
Well, for instance, yesterday, the banks outperformed the rest of, particularly the regional banks, outperformed the rest of the market. So I think that was an interesting sign. One, people not necessarily believing or looking at the valuation. If the curve stays this way, which I don't think it'll stay this way, there's lots of tools, right? First of all, the Fed can do Operation Reverse Twist, in which they unload their balance sheet at the long end and actually, right-size their balance sheet and buy more short-dated securities rather than take that long risk. And we as taxpayers would actually make money off the gains the Fed is making. So that's one way for the Fed to deal with it. Obviously, other ways for it to cut rates and create a positive curve that way. So I don't expect the curve to stay inverted for a long period of time. If you look at Gorman's comments yesterday at Morgan Stanley, he was talking about a 2.5% to 3% Treasury, 10-year Treasury at year end. We're going to have a strong job report. Consumer confidence is strong. And I think the recession fears are also a little bit misguided. Recessions happen, and I'm not forecasting one, but they do happen. But everybody's, extrapolating it that it's going to be like 2007 and 8, where we had some incredible excesses in credit, particularly in housing in the U.S. And, I don't see an asset class that's that big, that's that linked, that has that kind of impact that could cause that kind of a deep recession. So I don't expect the yield curve to stay here, and I expect banks to consolidate and cut costs and create a lot of earnings, simply through doing that. The tougher things are, the more likely M&A picks up.
Gotcha.
And given cost saves are so high with technology, I think the space is very cheap. You've got very high returns on equity.
Gotcha.
You've got dividend yields well above Treasury rates.